This headline is devastating for the West. China announces on March 22nd that it will not lower its rates and that it's starting to reduce its aid to the economy. At the same time, Joe Biden announced a $2 trillion investment plan, and the FED had already announced a few months ago that inflation is not such a big problem compared to the risks of a recession in the US economy. On the growth side, China has announced that it has set a growth rate of about 6% until 2025. As a reminder, 2025 corresponds to the end of its 5-year plan, which aims to finalize the catching up to the West in terms of advanced technologies. In summary, today we are witnessing the birth of a bipolar monetary world. The dollar and its expansionary policy have chosen to prioritize the performance of the economic fabric. As for the yuan, it is making a point of going against the dollar with a tight monetary policy to gain credibility, even if this is slightly to the detriment of Chinese companies in the short term. So now that we have a choice, what should we do? What can a world look like where capitalists collectivize the economy while communists bet on a strong currency to ensure a strong economic fabric in the long term? For your information, this video is largely based on the work of Gavekal Research and Gavekal Intelligent Software. I would like to thank them for giving me the authorization to popularize their work. Come on, let's go. As the economist Jacques Rueff said so well, economic stimulus policies through money printing consist of subsidizing expenditures that do not yield any profit with money that does not exist. What the USA is trying to do with its stimulus plan has already been tried many times in the world and in history, and it has always led to the same thing: an increase in the weight of the government and a generalized impoverishment of the population. I've largely explained this process in this video. To be even more precise, the shares of US spending is probably around 50%, whereas it was only 35% in 2000 and less than 10% at the beginning of the 20th century. The increase is therefore continuous and tends to accelerate over time. As French people, we know this very well since the European countries follow the same path with a few exceptions. In France, we have passed the 60% of the weight of the state, which is historically a red line of no return before a bankruptcy of the government in place. So it makes perfect sense to see the dollar lose value when you look at the dollar index. I have already said it several times on this channel, the problem of this dollar index is its composition. With more than 50% of being made up of euros, it does not allow us to appreciate the decline of the dollar against well-managed currencies that do not enter into this game of massacre of the value of their currencies. This is why the euro and the dollar have historically traded continuously. On this graph, we can see that it is inflation through purchasing power parities that makes the two currencies adjust in relation to a long-term median. The indicator shows that the fundamental balances between these two currency areas are stable. On the other hand, let's look at the dollar against the yuan. Looking at this ratio, which goes back to the end of the Mao era, which corresponds to the beginning of power of the reformer Deng Xiaoping, we can see that the dollar seems undervalued in relation to the yuan as it has never been since that period. But is it so sure that the fundamentals between these two economies are still stable? In an article for Gavekal Research, Charles Gave shows us the opposite. This graph is another way of explaining the variations in exchange rates between two currencies according to the expansion of the money supply of the two zones in relation to their respective economic growth. Thus, the purchasing power parity ratio allows us to evaluate an exchange rate when the fundamental economic equilibrium is stable, whereas this one allows us to evaluate if there is a break in this major balance. This does not happen every day, but when it does, it allows us to confirm with statistics what everyone else feels. So when the red line goes up, the monetary expansion relative to growth is higher in China than in the United States and vice versa. Charles notes that the bond yields in each of these two zones follow this monetary expansion ratio. This makes sense because a country's bond prices reflect the value of a currency. In other words, when you have cash and you want to keep it liquid without taking any risks, you put it in short-term bonds. This is why the yields on short-term bonds is called the cash rate. Well, this graph allows us to realize, as common sense tells us, and against all modern economic theory or not, that when we print money in large quantities, it has less and less value. This being said, the red curve took an extraordinary dive in 2020, which means that the US printed like crazy while China remained stoic by keeping a restrictive monetary policy. It is therefore logical to expect a rise of the yuan against the dollar. This is also why I no longer have any dollars in the cash compartment of the investment letter portfolio. For the dollar, the worst is yet to come, according to this model. That is why we expect Chinese bonds to rise against US bonds. On this chart, you can see that our choice in my investment letter to invest in the Chinese bonds is justified by a history in its favor. Since 1999, i.e. the Asian crisis, the performance of Chinese bonds has been slightly worse than US bonds with a yield of 6.4% per year, against 6.9% for the US, but with a much lower volatility and risk. However, we must always remember that bonds in a portfolio have a role of stabilizing the performance of the equity compartment. We must also keep in mind that the period of 1999 till 2020 was marked by a policy of undervaluation of the yuan by both the West and the Chinese. The US and Europe were quite happy to import goods cheaply in order to live beyond their means, while China was ready to sacrifice a generation of workers to the service of the West in return for its industrialization at the expense of the West. If the Chinese party succeeds in its 2020 to 2025 plan, then we will witness the rise of the yuan against the euro and the dollar, since China will have completed its economic transition towards domestic demand. Moreover, as the US and Europe are well on their way to consciously scuttling their respective currencies, this will only amplify this movement. On the inflationary trend side, as I told you in a previous video, our indicators show that the world continues to shift towards an inflationary trend. The last time I told you about it, only Sweden had gone into an inflationary trend. Well, today, 3 other countries that follow have joined the list: Brazil, the US, and Norway. The trend also seems to continue in the rest of the world. As a reminder, to calculate an inflationary or disinflationary trend, we calculate the short-term trend and a long-term trend. When the short-term trend is above the long-term trend, we consider that we are in a period of inflation growth. Now, we know that inflationism, if we can call it that, is very unfavorable to stocks because inflation devours the future and causes a contraction in the price-earnings ratio. In other words, there are periods when equity markets stagnate. Moreover, the biggest crashes, the Ursus Magnus, take place during these periods. We are living in a period of intense transition and the affirmation of a second economic and monetary power, which will make our era as exciting as it is complex. Stay tuned and see you soon for more videos. Ciao.
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.